Hello, I'm Dave Brinkman, partner in the wealth management practice out of our Columbus office, and I'm joined by my colleague, Jason Staley, our Chief Investment Officer on the personal side of the wealth management practice. Jason, how you doing?
Good. It's the Monday after the Masters. Scotty Scheffler, the only time I can ever say that a pro golfer will look like me is when he missed those two 5-foot putts back to back. Fortunately for him, he had a 5-stroke lead. When I normally do that, I'm not that ahead. So it was a great weekend. Getting ready, taping this, headed into Good Friday weekend. So interesting times in the markets, really interesting end to the Masters, and happy to be out here talking with you again.
It was funny, right? Watching the final round with my wife Sunday afternoon, and she's like, "How old is that guy?" She's like, "He doesn't look 25." It's like he's probably gonna have the same face at 40 that he does at 25.
I would say that he shouldn't be losing his ID anytime soon, because I think he's going to get carded for the next 15 to 20 years for sure.
Yeah. Let's go to the brilliant reference of The Godfather, and without stumbling on an introduction there, I'll segue to you on the Godfather piece that you put in the letter.
So as the resident film aficionado of Schneider Wealth Management, I thought it was prudent and timely that 50th anniversary of The Godfather that I would figure out a way to work a reference in. And I was actually watching The Godfather a couple weeks before the quarter end and right before the Oscars, and the character Virgil Sollozzo came up, and I thought about his kind of the way that he, his actions preceding his, and spoiler alert, but before Sollozzo meets his unfortunate demise, I was thinking about kind of his the things that he did that precipitated Michael closing that chapter, if you will. Sollozzo, as I described him in the letter, is kind of a mobster's mobster, and he wants to bring in narcotics into Manhattan. The Vito Corleone, who runs the Corleone family, is not crazy about drugs getting into the neighborhoods, and so kind of puts the stop to it, and Sollozzo puts out a hit on Vito Corleone that doesn't work, and everybody kind of knows that it was Sollozzo that did it, and he's set to scramble trying to figure out how to fix it, how to get a truce with the family, because things have just escalated. They're kind of getting out of control, and he's got to try to figure out a way to stop this. And it got me thinking just a little bit about kind of capital markets, and following the we'll call it the COVID lows of March of 2020, the Fed and Congress and really global central banking authorities did everything they possibly could to continue to have the economies that were essentially put into a coma, but markets kept rising, right? Because of all the stimulus and the low interest rates, everything that they could do, they did. And they're a lot like Sollozzo, which is like they wanted to do what they did what they thought was in the best interest of these entities kind of moving forward, and trying to stave off what they thought would be, but possibly a Great Depression. And they did, and they succeeded, and they should be applauded for that. However, it's not like you can just, introduce all of that stimulus into the system, all of those low bond yields, and then not have to deal with it. Eventually, you have to come to terms with your actions, which is a lot like Sollozzo facing the music with, which is that you don't just get to come for the king and not have any repercussions for it. And I think that you could make the case that the Fed has, been behind the curve as it relates to the U.S. Federal Reserve being behind the curve in terms of taking inflation a little bit more seriously. They kept a lot of the word that we heard over and over again was transitory, as if this inflation was going to go away. Well, guess what? It's not. Can't put that much stimulus into the system and not have after effects. And again, I'm not saying that this is going to be some world-ending endeavor. That's not what we're saying here. But you also have to face the music, and that's what the volatility that we saw in the first quarter was, just markets facing the reality that there's no free lunch. You don't get to have 21 months where it was pretty smooth and easy, and not have to pay for that eventually. And that's what we saw. And markets were resilient in the first quarter, but there was a lot of volatility, which is why we titled the quarterly letter Revenge of the Volatility. And we came up with the Salazzo reference, which is all about kind of facing the music. I do think it creates an interesting analogy and kind of sets up, the rest of this conversation and the rest of the letter, which is how are we going to deal with volatility for the first time since March of 2020? All eyes are on the Fed. All eyes are on the yield of the benchmark 10-year Treasury, and that's going to tell us a lot about where this market's going to go.
Let's go back and color in with maybe some numbers on the volatility, and then I want to go right to where you just went, which is expectations on the Fed's ability to continue to navigate this. So in your quarterly letter, which I'm looking at here, right, you mentioned the max drawdown. So the S&P 500, and again, for the audience, most recent highs, and then, what does it decline by? S&P 500, we experienced a 13% slide intra-quarter. NASDAQ, or large cap growth, right, or a proxy for large cap growth, off 21%, bear market territory. And Russell 2000, or small caps, off 15. Volatility that up until, the COVID first quarter of 2020, we had not seen for 21 plus months. That, and then I'd like you to go a little bit deeper for the audience, because the other issue decline that you're seeing is high quality bonds, or the Barclays aggregate, off 5.9% quarter to date, right through 3/31 of 22. So you had a lot of volatility in equities, and you had bonds selling off. Basically, I won't call it a perfect storm, but there weren't a lot of places to hide that weren't going to experience some volatility in the first quarter of 22.
Yeah, I think that's the volatility, kind of, again, going back to the title, we actually had it. And volatility is normal in markets. And the way that I kind of frame it is that you should expect volatility in the equity markets. We hadn't had a whole lot of it over the last 21 months, 7 quarters, but typically you get 2 to 3 drawdowns of 10%. In the S&P 500, that's normal.
But isn't that why, as equity investors, right, that short-term volatility is why you get rewarded over the long run, right?
Correct. Exactly right. If you wanted a fixed rate of return, you go into the fixed income. I think what is interesting in the volatility that we are all having to work through now is this bond volatility. To your point,
exactly.
High quality bonds are down 6%. You want stocks and bonds to be negatively correlated. And for the last 40 years, anytime there has been what I'll call risky asset volatility, whether that's real estate equities in the great financial crisis, tech in the dot-com bubble, right, when the NASDAQ burst and you saw really large drawdowns there. High quality bonds had been there to kind of be the ballast of your portfolio and to really dampen that volatility, right? When stocks are going down, bonds are at least holding their value, worst case scenario, or they're going up, and that's been kind of the way that you have been able to manage through volatility. And I think that it certainly caught some clients of ours, and I think investors, off guard when stocks and bonds got positively correlated to the downside, which is to say they were both falling. And in the case of the Barclays Ag, it underperformed international stocks, it underperformed large cap stocks, and roughly got you, sort of in line with what small caps and mid caps did domestically. And that was, I think, a shock to the system. And one of the things that I can say that we at Schneider Downs were acutely aware of, there was a possibility that stocks and bonds could get correlated down the road. And that's just because at a certain point we felt like rates would have to go up. When rates would go up, initially that would potentially have an effect on stocks, make them more volatile, right? One of the justifications for stock valuations moving upward was that, well, interest rates were low. So it stands to reason that if interest rates go up, the valuations of stocks might come under pressure. And that, we understand kind of bond math, which is, for those, I've done this, I think every, bonds are a seesaw, prices go up, yields go down, and then vice versa. Well, we're getting the vice versa. Yields are going up, prices are going down. And what we did proactively, starting in 2017, was really lean into this idea of real assets. And every year we would kind of continue to lean into this real assets, carve a little bit more out of core bonds, slide that into something that we felt like, one, would protect us against inflation should we ever get it. We weren't calling for inflation, but real assets have had that effect where they're able to grow their cash flows with inflation. But the second thing was, we just felt like if rates went up, that would put pressure under core fixed coupon bonds, and that real assets would give us more ways to win. We'd have more levers to pull on to earn rates of return. And so the ballast of our portfolios in the first quarter weren't necessarily high quality bonds. They drew down just as much as stocks. Kind of the ballast of our portfolio was these real assets exposure, high quality commercial real estate, and then infrastructure, farmland, and timberland, and then a global manager that has a more kind of a fortress type balance sheet on stocks, and then has some exposure to things like gold and a cash position, right? These were the kind of things that were able to kind of move us into, or kind of for us to point to and say, there are some things in your portfolio that worked. What I will say is it's applying a unconventional framework to what we think are kind of unconventional times, and that's just it's just the sense that we've never had this much fiscal and monetary stimulus in the markets. And
well, let me add on to that. So this is truly unprecedented times. You mentioned it in the letter, right? So we have Barclays aggregate, or basically let's say taxable bonds, off roughly 6%. You've seen that continue to slide off almost 8% as we're filming this today. And the big thing is you've seen the 10-year Treasury go from 1.5 at the start of the year to what, 2.7, 2.75. That's
almost
an unheard of,
almost 2.8% today.
That's an unheard of move in 90 days, right? And the reason, I mean, look, there's never simple answers to this. Capital markets are complicated, so I don't want to overly simplify it. But you've got inflation running at 7.5% for the last 3 to 4, 5, 6 months. And alluding to what you mentioned earlier, historically speaking, the number one way to fight inflation has been to raise interest rates. And, if I'm hearing the Federal Reserve correctly, or if capital markets are hearing the Federal Reserve correctly, they are trying to telegraph 6 to 7 additional rate increases between now and the end of the year. And oh, by the way, they might not be your garden variety 0.25% interest rates. They might be going at 0.5, right? And therein lies the forward-looking commentary. Humble opinion, this volatility that we've seen, it's going to be around here, because historically speaking, the Fed's track record of navigating what you'll hear is a soft landing, right? Raising rates, but not too much to push us into a recession, is below average at best, right? Would you agree with that?
Yes, I would say that the Fed's ability to tamp down inflation, that I think that they've actually shown that they've been able to do, but it has come at the expense of putting the economy into a recession. They've never been able to successfully do it where they reduce growth but don't kill growth. And I think that the destructive nature of the back end is something that we will need to watch, because I think that and this is something that's always scared me, right? I think that we're all a product of some of our experiences. And my parents, they got their first mortgage in 1980. That's when they got married. Yeah. They had my brother and I 2 years later. They were public school teachers making $22,000 a year combined, and their interest rate on their house was 16%.
Yep.
So you can imagine how well it's received when my dad hears me complain about my mortgage payment every month, and the interest on my mortgage, which is to say, he tells me politely to be quiet and stop complaining. But I think that and that ended up, the Paul Volcker ended up putting us into a pretty severe recession. He raised the interest rates 200 basis points in one weekend, over the weekend, just like
right.
And what he was worried about essentially was, when you go back and you read what he was thinking at the time, was that the longer inflation is in the system, the harder it is to get it out.
The stickier it gets.
The stickier it gets. And so the Fed is hoping that some of this, what we'll call COVID or cost push induced inflation, starts to roll over, and that we're able to kind of get the labor market, which is really hot in terms of, one, the amount of people looking, or kind of that are filing jobless claims, and two, just the wage pressure that we're all seeing, hoping that somewhat is somewhat gets under control. And that is the Goldilocks scenario, to your point, of this soft landing. I always compare it to Captain Sully, who landed the plane in the Hudson. 7 or 8 years ago, which is, if you had to do it 100 times, could he do it? I don't know, but the one time he had to do it, he did it. And that's kind of what the Fed is attempting to do, which is to be Captain Sully, to raise interest rates enough to combat the inflation, and at the same point, kind of continue to have growth be, positive.
Do I have that right? So, and it's spoiler alert if you haven't seen that movie, but the regulators, right, when they were simulating that in the plane, they instantly turned back to go land at the airport. And we finally said, well, that's all well and good. You already knew you were going to crash, so you knew you were going to turn around. But what happens when you're in the moment and you have to count to 30 and then try and land back at the airport? You can't do it. And that, if I recall right from that movie, that's basically what got the Captain Sully justified, was to say, no, you guys are doing it instantaneously, wait 30 seconds. So basically, if we apply this to capital markets, Federal Reserve, to get this perfect landing in hindsight, right, which will be obvious 5 years in the future what they should be doing right now, but in the moment, it's not exactly clear, right?
Yeah, and I think that's why you're seeing all this volatility, because previously this Fed was very dovish. They were very certain that this was going to be transitory. And then you have governors like, Governor Brainerd, Loretta Mester up in Cleveland, who were previously more dovish, are coming out and saying, we are concerned about inflation. It has our full and undivided attention. And we're starting to see bond markets go up, to your point about the 6 to 7 rate hikes. And we're also seeing, volatility in the stock market. But I also think that it's important, and we note this, is that volatility in the stock market is normal. And while we haven't seen this particular set of backdrops, this particular set of circumstances in terms of rising inflation, significantly rising bond yields, to your point, we haven't seen that in 40 years. We have seen a lot of volatility. It's just, I think we have, as humans, we have recency bias, and we tend to overweight things that have happened more recently and discount them that have happened further in the past. And so, yeah, I think that there's going to be a tendency to really to think that this volatility is out of the ordinary. And nobody has a crystal ball, but I think that there are some things that you can do to protect your portfolio. One of them is to I think apply more of an unconventional framework to fixed income. And then I think on the equity side of the house, when we talk about this, is that providing a little bit more of a conventional framework to equities, which is that it's a stock, it's a risky asset. There's a reason that you earn the equity premium over a market cycle, is because you're going to experience some volatility. Stocks have the ability to go down much more than bonds, and kind of that's where the saying comes from: a bad day in the stock market is a bad year in the bond market. Right. It's important to keep that into consideration as we continue to go through these more difficult times, is that volatility is normal. And it's because of that volatility, Dave, and I think that that's something that you indicated earlier, was that because this volatility exists, because stock prices can go up and down, and we've got a pretty interesting chart that Lizanne Saunders put together from Charles Schwab, she's the CIO there, that shows just the S&P 500 drew down 13%. The average constituent, Dave, can you take a look? What's that you've got in front of you? What's the
average constituent was off 19.
Was off 19. So again, I think that there's this, you have to just understand that volatility is going to come. Stock prices are going to go down. Just because you see some stock referenced on CNBC that's down 70% doesn't mean that you own a significant amount of that particular said stock that is going to affect your portfolio. But just over time, volatility creates buying opportunities. That is what it has been historically. And the reason that you have these kind of productive two-way conversations as advisors and clients is because it helps you get through that volatility. It helps you not lock in the losses. And I think that, again, having these regular updates with clients and advisors is really healthy. It allows you to convey these messages that I know that we haven't experienced something since COVID. And no one really wants to think about COVID because we're all trying to get on with our lives. We don't want to remember what those lockdowns were like. I know I personally don't. And this is it's something that, like, to your point, it's not going to go away, and we just have to be prepared that there's no silver bullet to it other than time. and really understanding what's going on and making sure that you have a plan. And that plan is constantly being looked at, because the trajectory of your portfolio, as long as it's still in compliance and still looks good with your goals and objectives and your overall financial plan, I think that's the comfort that you get to get through these tough times.
Yeah, I mean, that would be our role. It's not just Schneider Downs Wealth Management, but to the extent that the audience is working with other advisors, right, is the advisor should be that consistent, rational voice throughout these periods of volatility and uncertainty. You know, the basic blocking and tackling. What are your cash needs in the next 3 to 6 months? Let's make sure none of that's riding in the markets, so that, you know, that we're adding on to your anxiety in volatile markets. It's really that consistent approach. That should be the value you receive from a third-party advisor, is kind of making sure that you don't get too short-term aware, if you will.
Yeah, exactly. And I think that there's a lot of uncertainty. I know that we were talking about it before we got on. When you think about where the 10-year Treasury was to start the year, I mean, where it was to start the second quarter, to see where it is, to see, we had, I think at one point there was something like $16 trillion of negative yielding debt,
right?
Just out there globally. It's inside of, I think, 8, it might even be 7, and that's going to cause a lot of pain. There's going to be there's going to be an adjustment in the fixed income markets. There's going to be adjustments in equity markets, and I think that unfortunately, I think we're going to be in an era that is going to be that will be more akin to what we've experienced in the first 10 years of the millennia, right, from 2000 to 2009, where we had much more volatility. Still, upward trending markets, but more volatility than we had in the last 10 years, which was a low inflation. I mean, we threw trillions of dollars trying to create inflation from 2009 to right up to COVID, and we weren't able to do it. We couldn't buy inflation if, that's the running joke. Right. We did all this quantitative easing, Operation Twist, the Japanese central bank kind of pegged the 10-year at 0. They were going to defend the yield to be 0 or negative yielding. We did all this and we couldn't create inflation. It took a 1 in 100 year pandemic to create inflation. And it's going to take us a little bit of time to navigate through it, and kind of for capital markets to figure out exactly how to react to it.
Right.
Yeah. It's just,
yeah, and I don't think we need to get into it. We didn't even address Russia-Ukraine, right? And it appears as though we're having a little bit of a reset on that engagement. So that's going to lead to even additional volatility, right? And maybe closing thoughts for the audience, right? The simple answer is, I think if I'm hearing you correctly, is markets we expect to continue to be volatile. Maybe not as volatile as they were in January, February, but I think the up and to the right smooth exercise of the last 2 years, that's the abnormality, not this first quarter.
Exactly right. And I would say that obviously, the war in Russia and Ukraine is seemingly to hit a pause, but it's likely that fighting will escalate, and that's going to create a cloudy picture from an investing standpoint in the near term. Longer term, I think that we are certainly constructive on international equities. It's kind of hard to talk about the investing opportunity given all the suffering that's going on in the Ukraine right now. I know that I speak for both of us and the team, where those pictures are hard to look at, and there's something that we'll never forget, and our thoughts and prayers are with them. And we're not geopolitical analysts, so I'm not going to kind of opine on the timing there, but that's going to inject that more uncertainty, right? Capital markets like certainty. That is something nobody can get inside of Vladimir Putin's head but Vladimir Putin. That's going to create more uncertainty, which is going to create more volatility. But I think the markets are resilient, and I noted that in the note. Well,
you saw in the first quarter. I mean, markets were resilient in the first quarter. I mean, we're not asking anybody to be happy, but S&P 500 was off 5 or 6, and it easily could have been off double digits.
It rallied 11. The S&P 500 rallied 11% off of its lows. So market timing is really hard. If you want to add a little bit of capital on weakness, I think that's always something that has historically been rewarded. It's just not going to be as clear, and it never is. No one really wanted to buy on March 23rd of 2020.
No.
But if you did, you would have doubled your money.
Right.
And I think that's what I think makes investing so hard, is that it is truly a marathon, not a sprint. And that's the one thing I want to leave, our clients, the friends of the firm, and the rest of the audience, is that investing truly is a marathon. And sometimes it can seem like a sprint because we have greater access to market data and transparency. Right. And I mean, Elon Musk can take a 10% position in a publicly traded company and announce it on Twitter that he took a 10% position in Twitter, and the stock price goes up 40%. These are, in the moment, you can see that return, or you can see things that are going to the downside, and you kind of forget that financial plans. I mean, we don't show people financial plans that are 12 months in scope. We don't even show them that they're really 12 years in scope, right? We're looking at longer term kind of trends, right? And that's where it just all kind of ties back into the investment being a marathon. And I think that our job now, and I think that the job of us as advisors and investment professionals, is to really, you take a step back and understand, our clients, are you absorbing the volatility in a way that you should? Or is this creating consternation? Because eventually the portfolio that you need to own, it's really easy to be a 70% equity, 30% fixed income or strategic income investor when markets are going straight up. Holding that in 2020 and 2021 was not an overly difficult exercise. But are you really a 70-30 investor when stocks and bonds are down at the same time? Can you take that? Can you absorb that? Because you need to hold those portfolios through the worst of times, because that's when you really get tested about your true risk tolerances. Right. And I think this is another opportunity to reevaluate risk tolerances and to have those really productive conversations that ultimately are the things that lead to these great outcomes and reaching goals and objectives over the long term.
So this is just the most recent test for investors, and there will be several tests to come up in the future as well.
That's exactly right.
Why don't we end on that? Jason, thank you for your thoughts and perspectives, and we appreciate the audience taking some time to listen to us.
Thanks, guys. Look forward to seeing you again soon.